If you're a highly compensated employee, you're probably wondering how to lower your taxes, and you've probably heard of the term deferred compensation. Today's video, we're going to cover what deferred comp is, how it can help you supercharge your retirement savings, how it helps you lower your taxes, and make sure that before you enroll, you understand some key considerations that may impact you. I'm Brennan, Decima, owner of Decima Wealth Consulting, and we help executives plan and prepare for their retirement. So let's start with what deferred compensation is. So really simply put, deferred comp is an employer benefit for highly compensated individuals. It allows you to save on a pre-tax basis above and beyond the 401k limits. So 401k limit is $23,500 if you're under 50. If you're over 50, you get to contribute another $7,500. So let's say you're over 50, you can put in $31,000. Well, if you want to save more than that and get an additional tax deduction, that's where the deferred comp comes in. It allows you to save above and beyond the 401k annual limits. There is no dollar limit to the amount that you can put in a deferred comp plan. Now, each employer is going to have rules for what percentage of your compensation you can put in. But the benefit of this is most retirement experts suggest saving 15% of your compensation on a pre-tax basis to be on track for retirement. Well, let's say you make $400,000 or above. 15% of $400,000 is $60,000. Well, that's double what you can put in the 401k. So that's why the deferred comp was created. It allows those higher income earners to save more for retirement, to keep them on track just like everyone else is. The other benefit is it's going to give you, a tax deduction if you're a highly compensated individual. So let's discuss the three benefits. Number one, if you're in the highest bracket or a high bracket, you are reducing your taxable income. So you're potentially avoiding 35, 40, 50% in taxes depending on your federal and state tax rate. So you're keeping that money, right? So lowering your tax bill. And if you're in a lower tax bracket in retirement, that's tax bracket arbitrage. That's fantastic. Number two, well, compounding increases as well because the money that would have went to taxes is now invested. This allows you to keep more of your money earning, which is really, really powerful. That compounding ability really, really allows you to grow more for retirement. And then the third benefit is the company match. So with the 401k, most employers, if you max out and you're not in deferred comp, well, your company match stops as well. Well, many employers that we work with, their match continues for their deferred comp plans, allowing you to get more company match from your company. So lower taxes, more compounding, more company match. Really, really powerful. Why wouldn't we do it, right? So why wouldn't we want to lower taxes? Why wouldn't we want more compounding? Why wouldn't we want more company match? So let's talk about some things to be aware of before you enroll. So number one, a deferred comp plan is not the same as a 401k in the sense that it is an unsecured account. So a 401k, your money is separate from the company. With a deferred comp, you're on the balance sheet. So if the company goes bankrupt, you're on the hook. So really want to make sure you're not working for an Enron type company, right? So first consideration. Second consideration is it's much less flexible. So when you enroll in deferred compensation, typically you don't have the ability to change your contributions until next year's open enrollment. So this is where planning becomes incredibly important. We want to make sure we've reviewed the liquidity needs for the next 12 months. Are there big renovations, weddings, anniversaries, tuition, loans that are due? So if you have a high probability of a big cash outflow the following year, unlike a 401k contribution, you most likely cannot adjust your deferred comp contribution. So really, really important to model out cash flow in the short term. The third is the distributions typically are defined in advance. So unlike a 401k that can be rolled over to an IRA when you leave or left alone until mandatory distribution time period, The deferred comp distributions are set in advance. So you need to decide how they will pay out on the back end. And normally there's limitations to changing that. So the IRS says that if you do change, if your employer even allows it, not every employer allows you to change, but for those that do, typically it's very, very restrictive on how you can change it. So number one, if you make a change, it needs to be at least 12 months prior to you leaving the company. And I'll give you a really powerful example of why that matters. The second is, if you do change it, the distribution start date needs to be pushed back at least 5 years. Well, that can be a massive difference in your retirement planning. So let's go back to that 12 months. We're in an environment where people are getting laid off left and right. Well, if you're paying out on a lump sum when you leave and you get laid off, but all of a sudden you're going to another competitor or employer that's paying the same amount, well, now you might have a massive tax liability because you weren't planning on retiring. So evaluating what the payout schedule is needs to be done in advance. So a couple things to think about. One, when you're doing contributions, we want to model out what your liquidity needs are for the year and make sure that you have plenty of liquidity outside of the deferred comp contributions. Number two, for distributions, it makes sense to think about how they will pay out. And normally you have two options on the payouts. Option one is a lump sum. Now, the benefit of the lump sum is because it's an unsecured account, you're reducing that creditor risk. You're getting all of your assets back sooner, so you don't have to worry if the company becomes insolvent after you leave. That's great. Benefit two is you now have full control. You can invest it however you want. You may have more options outside of the plan. So lump sum is great. However, a couple of detriments to the lump sum. One, it's fully taxed when it arrives. You cannot roll it over. So for a lot of the executives we work with, when they retire, they may have stock awards vesting, they may have a bonus, they may get a severance if they're laid off. And that lump sum potentially pushes them into a much higher bracket than when they even deferred, negating the benefit of the deferred comp. You just gave up all this flexibility and paid more in taxes. So it's really important to think about when you're leaving, what other income will you have the year you leave? The other thing to be aware of is you can take installments. Well, installments are typically paid on an annual basis. Now, again, you're keeping that creditor risk for longer, but it allows you to continue deferring taxes and compounding on the deferred tax portion. It allows you to better control your tax rate over time. So instead of getting it all at once, maybe you push it out until after your stock awards are behind you or after your second career act is behind you, which allows you to get it at a lower tax rate, keeping more of that nest egg. The other benefit of installments, and this is a little known concept with deferred comp, but with deferred comp, the payout is taxed in the state you earn it. So if you get the lump sum, let's say you worked in Connecticut, you retire in Florida, you get the lump sum. Well, you still owe Connecticut state taxes. With installments, if the installments are spread out 10 years or greater, 10, 12, 15, 20, then the taxes are owed in the state you reside in. So if you're Connecticut moving to Florida and you spread your installments out over 15 years, you're not paying Connecticut state tax. So that's something to be sensitive to as well. So as you think about open enrollment, as you think about your needs for next year, deferred comp is a great way to lower your tax burden, improve your compounding, and potentially get more of your company match. If you would like help modeling your own tax efficiency for accumulation and distribution, visit us, www.decimawealth.com, to see how deferred comp fits into your overall financial plan. Thank you, and please subscribe.